How does inflation affect tail risk hedging? Have you ever wondered how inflation impacts your investment strategies, especially when it comes to tail risk hedging? Let's break it down in a straightforward way. Tail risk hedging is all about protecting your portfolio from those rare but severe market downturns. This is often done using options, particularly put options on broad market indexes. When the market takes a sharp decline, these options increase in value, providing a safety net. Now, inflation plays a significant role in how effective tail risk hedging can be. First, let's talk about market volatility. When inflation rises, uncertainty about the economy also increases. This uncertainty typically leads to higher market volatility. With more volatility, the cost of options goes up because pricing models take into account these expected price swings. So, if inflation is high, you can expect to pay more for your tail risk hedges. Next, we have option pricing and volatility skew. Inflation can change how implied volatility behaves across different options. During inflationary periods, more investors seek protective puts, which drives up the demand and, consequently, the implied volatility of those out-of-the-money puts. This means that the premium you pay for these tail risk hedges increases, making it more expensive to protect your portfolio. Interest rates are another factor influenced by inflation. Central banks often respond to rising inflation by increasing interest rates. Higher interest rates can affect the cost of carry-forward options. For example, as interest rates rise, the yield on risk-free assets like treasury bonds also increases. This can help offset some of the costs associated with buying options, but it also changes how your overall portfolio behaves. Now, let's consider how all of this impacts your tail risk hedging strategies. When inflation is high, the costs of options and market volatility can make these strategies less efficient. For instance, if you are investing in out-of-the-money put options and treasury securities as hedges, you might face negative returns when inflation drives up option premiums and interest rates rise, which can hurt bond prices. For traders and portfolio managers, it is essential to take inflation into account when designing tail risk hedges. In an inflationary environment, you might want to adjust the strike prices of your put options to find a balance between cost and protection. Additionally, using a mix of options and inflation-protected securities can help manage your risk more effectively. Keeping an eye on implied volatility and inflation expectations can also help you time your hedge purchases wisely, so you do not end up overpaying. In summary, inflation tends to increase market volatility and option premiums, raising the costs associated with tail risk hedging in stock trading and options markets. It also affects interest rates, which interact with hedging costs and portfolio returns. Adjusting your strategies during inflationary times is key to maintaining effective protection without overspending.